Thank you, Stefan. Nuclear physics and modern accounting standards and auditing standards. I would say that the nuclear physics is probably far more complex than the accounting standards, but it's relative, I'm sure. So I want to start with just a little motivation slide here. This we have on the right side a report from October 2008 in Al Jazeera, where they're reporting that Alan Greenspan has admitted a flaw in his ideology. And of course, this was in the wake of the financial crisis of 2007, 2008. And it took almost 10 years for the Financial Accounting Standards Board in the United States to take probably the most important step in fixing some of the accounting problems that may have contributed to the crash in 2007, 2008. And as you can see from the left side of this slide, there's a heading, why is the FASB issuing this accounting standards update? Current generally accepted accounting principles require an incurred loss methodology for recognizing credit losses that delays recognition until it is probable a loss has been incurred. And because of that, both financial institutions and users of their financial statements express concern that current GAAP restricts the ability to record credit losses that are expected but do not yet meet the probable threshold. So the probable threshold was interpreted to mean more than 50% chance of losing the entire financial asset. So say, for example, you were invested in a single mortgage of a commercial building. That mortgage would be written off entirely once it was more than 50% probable that it would not be paid. But if you felt like there was a 10 or 20% chance that it wouldn't be repaid, there was no need to report any loss. And so what was happening back before 2007, 2008, and actually before these standards came on board just a year or so ago, is that there were these credit losses that were building up below the 50% threshold. And then once they got beyond 50%, they were just exploding into the financial environment. And suddenly, oh my gosh, we have all these losses. So we're going to talk about, they're going to skip over the abstract here. I've just talked about the motivation for the changes in accounting standards. Those changes in the accounting standards were accompanied by changes in the auditing standards. So in the accounting and auditing world, we split the two groups. We have the auditors on one side and we have the accountants on the other. Oftentimes they do a way more mixing than they should. But in terms of the standards, there are separate bodies of standards. So we'll look at some of those and talk about how these standards can be visualized or interpreted and considered through Bayesian networks. So we're going to define audit risk and audit evidence. We're going to discuss a new CECL rule, where CECL means the current estimate of credit losses. And so this is the new rule that the FASB has issued that now requires a more continuous variable evaluation of the probability of the credit loss, as opposed to the previous binary more than 50% rule. And then we're going to look at just modeling the risk of material misstatement. And I will tell you here that prepared this model in both BayesiaLab and Agena Risk, and was racing to get my BayesiaLab version ready for this presentation, but I ran into a problem with my noisy OR function. And so I will seek some advice on that later on, but we'll go ahead and dig into this. Audit risk defined. So generally accepted auditing standards say that auditors have to develop reasonable assurance about whether financial statements are free from material misstatement. And so this is interpreted as a high but not absolute level of assurance. And it requires audit evidence to reduce audit risk, which is the risk the auditor expresses an inappropriate opinion when the financial statements are materially misstated. So we want to reduce that audit risk to an acceptably low level. This vague language permeates auditing and accounting standards, and it gives rise to a lot of wiggle room and a lot of really confusion, I think, in how they should be interpreted. This is a very, very common thing to see. Drilling down a little bit more, audit risk is a function of the risk of material misstatement and detection risk. For the risk of material misstatement, the assertion level consists of inherent and control risk. These are entity risks independent of the audit. So in other words, the auditor is responsible for their detection risk, but the company or the auditee is supposed to deal with inherent and control risk. So we can say that detection risk is a function of audit procedure effectiveness and application. So are they good procedures and are they being applied thoroughly? So auditors can use different approaches to assess the risk of material misstatement, including a model that expresses the general relationship of the components of audit risk in mathematical terms. So this piece of the standards really explicitly authorizes the use of tools like Bayesian networks to model audit risk. So audit evidence, this is information used by the auditor in arriving at conclusions on which the auditor's opinion is based. It includes information contained in accounting records underlying the financial statements and other information. Cumulative in nature, includes information from prior year audits, and it should both support and sometimes contradict management assertions. So you're required as an auditor to evaluate both bodies of evidence, the supporting and contradicting evidence. So there's a relationship in the inherent risks. There's like 6 specific inherent risks that have been identified by the ICPA for privately held companies and then by the PCAOB for publicly held companies. We have uncertainty, subjectivity, and management bias are 3 of 6 inherent risk factors. And there's a relationship between these as explained in this little paragraph here, where estimation uncertainty gives rise to inherent variation in possible methods, data sources, and assumptions that could be used to make an accounting estimate. This gives rise to subjectivity, and that hence the need for the use of judgment in making the accounting estimate. So these judgments are required in selecting the appropriate methods, blah, 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 in making the assumptions and selecting management's point estimate. So this is another defect that any Bayesian will recognize, that we're relying on these point estimates instead of tackling the full distribution of the estimates and the probabilities. So the subjectivity in judgments creates the opportunity for unintentional or intentional management bias in making these judgments. So that's a little bit of background on the auditing standards, and then we're going to switch over now to the accounting standard. So this is issued by the Financial Accounting Standards Board here in the United States, whereas the auditing standards are issued by either the AICPA or the PCAOB. So the CECL rule, CECL, again, it stands for the current estimate of credit losses. So these estimates are supposed to be made by companies that hold financial assets like trade receivables, notes receivable, which is payable, all kinds of debt. Banks obviously are big holders of this kind of thing, but they also have big manufacturers that would be issuing credit to buyers. And so there are a lot of companies that have these kinds of assets that need to be evaluated to determine whether they're going to be repaid or not. The focus is on cash flow. Is the cash going to come in or isn't it? And it used to be that you'd have to wait until the whole thing was probably not going to be collected. That was under the former accounting rule in order to recognize any credit loss. And under the new rule, you're required to make a current estimate of the credit loss, even if the probability is remote. The accounting standards continue to have a problem with evaluating probabilities. They don't take a very sophisticated view of it. It's still kind of a discretized high, low, medium. Nothing against discretization, of course, but too much discretization can be dangerous. That's still what happens a lot here in the accounting arena. So anyway, this is saying that it allows for credit losses. And by the way, how much time should I expect to be using here? Do I have 8 minutes or do I have 18 minutes?
Yeah, you have your originally allotted time.
Okay. All right. The allowance for credit losses is a valuation account that goes on the balance sheet. It doesn't say balance sheet there, but that's what it is. And it's deducted from the amortized cost basis. Just for example, if you went out and you issued a trade receivable, maybe Boeing tells Delta that they can pay on time. And it might be a $10 million trade receivable that Boeing is holding. So that $10 million amount would be the amortized cost basis unless something funny comes up. So what we would want to do is we'd want to subtract the allowance for credit loss from that 10 million receivable and present on the balance sheet the net of the original 10 million and what we think is the probable loss on the receivable. We can always also do this on a pool basis where we throw all the trade receivables as long as they have common risk characteristics we'll look at in just a minute, and we can pool them. So anyway, on the balance sheet, there is this allowance for credit losses. And then in the income statement, there is a corollary credit loss expense that reflects the amount necessary to adjust the allowance for credit losses for management's current estimate of expected credit losses on financial assets. So it's a continual updating process. And you're reevaluating every year or every accounting period how much you expect to lose. And then you need to recognize in income either the increase which would in the loss expectation, which would be an expense, or it would be a decrease, and then it could be an income item. So you can measure, as I mentioned, on a collective pool basis when similar risk characteristics exist. If an entity determines it, and then if they don't exist, the next bullet's just saying, then you do it on an individual basis. So here's some of the risk characteristics, and you can think about how these things might interact in a Bayesian network where you're trying to compare the risk characteristics of different financial assets. So internal or external credit score of the person that's indebted or the entity that's indebted, risk ratings and classifications, financial asset type, size, effective interest rate, geographic location, the industry, the vintage, how old is the receivable or the financial asset, historical or expected credit loss patterns. And this is really interesting, reasonable and supportable forecast periods. So that reasonable and supportable language comes up all the time in this new standard in relation to the accounting side and measuring the probable loss. So you can use all kinds of different methods. Some of them that they mention in the standard are discounted cash flow, this loss rate, roll rate, probability of default methods. So probability of default, that sounds like it fits right into the framework of Bayesian networks, or that Bayesian networks fit into this framework anyway. You have to consider available information relevant to the collectability of cash. It can be external, internal, or combination of past and current events. And there's that reasonable and supportable forecast language. You have to consider relevant borrower-specific, qualitative and quantitative operating environment factors. Where are you operating your business and what's different about that environment? As an extreme example, maybe you're operating in a business over in Ukraine right now, or somewhere in Europe that is close to the Ukraine-Russia conflict. The standard says that you're not required to search all possible information that is not reasonably available without undue cost and effort. You shall not rely solely on past events. You have to consider what you think is going to happen in the future. And the CECL down at the bottom here shall include a measure of the expected risk of credit loss, even if that risk is remote, regardless of the method applied. That's a new one. The most important bullet on this slide is that estimating expected credit losses is highly judgmental and requires an entity to make specific judgments. So there are all kinds of subjective judgments that have to be made here. And there are all kinds of different results that could come from different people applying this standard. So here's my BayesiaLab model, and we'll just kind of walk through the nodes here. The nodes in light blue or in teal here, these are inherent risk factors or inherent risks, I guess we should say. So we have the complexity of the accounting and complexity of the environment itself. Any changes that are going on in the environment, whether it's changes in the industry or changes in the overall economy, uncertainty of all kinds of varieties. We have subjectivity. This business of estimating CECL is highly subjective, highly judgmental. And if we were recording evidence in the subjectivity node, it would definitely be high. We also have management bias here, which is affected by uncertainty and subjectivity, as well as by fraud. And you can see my little warning signs here for my two noisy or no probability tables that are still to be completed. But so these are all the factors. These are inherent risks. And this management bias is affected by what we call the fraud triangle. This is the attitudes of management, their opportunities to engage in fraud, pressures to engage in fraud. These three factors then impact the probability of fraud occurring. And then if fraud occurs, this could drive biased responses by management. And then that in turn can drive a materially misstated current estimate of credit losses. So those are the inherent risk factors. These are the fraud-related risk factors. And then we have the company's controls over here, and then the detection risk. So this is essentially the audit risk of misstated financials. Okay, so now let's go to look at the Gina risk rendition of this. You can see that it looks very similar to what we have here. I'll have to admit that the BayesiaLab view it looks more polished. I'll give BayesiaLab that. And it's a pretty picture. This is also a pretty picture, and it has the advantage of the noisy ORs working for me. So it's got that going for it. So anyway, what we've done here is come up with this is a prior distributions here, prior probabilities of these factors being in existence. So we've got complexity could be high or low. And since these are marginal probabilities for a non-child root node, we have 80% of the time, we're going to expect that the complexity is low, and 20% of the time that it's high. So you can see that what I'm doing here is it's a very completely theoretical model. There is no data in the traditional sense to back it up. It's all expert elicitation. And so there are ways that we could incorporate data into some of the nodes, but a lot of it is going to remain only judgmental. We've got the complexity, we have the change, 30%, 70% allocated to a little and a lot of change going on. Uncertainty, 80% low uncertainty, 20% high. Subjectivity, 77% low and 23% high. And then management bias, of course, it's got its own result based on the parent nodes. When we enter in a little bit of evidence into the model, we'll say that complexity is high. And you can see what happens to the probability of materially misstated estimate, as well as some of the other changes occur here with control risk and detection risk and so forth. As the complexity goes up, we go from a 59 or 60% probability of a materially misstated estimate up to about 85, 86% probability. That's the model. And so I'm curious if there are comments or questions about it. I'd love to hear what you guys have to say. I'd also love to hear what you have to say about noisy ORs in BayesiaLab. We can do that another time if you like.